The S&P 500 has long been considered one of the most reliable and effective investment options available. Its track record of strong average returns has made it a central component of many portfolios, for both individual investors and large institutions. However, despite its solid reputation, there's a critical aspect of the index that's often gone unnoticed. While the S&P 500 does an excellent job of representing major U.S. companies in the broader economy, it is not without flaws. To understand the issue, it's helpful to begin by understanding what the S&P 500 is and how it works. The index is designed to track the performance of 500 of the largest publicly traded companies in the U.S. These businesses span a wide array of industries, including tech, healthcare, and more. Because of this industry diversity, the index is often considered a proxy for the overall U.S. economy. When people refer to the market, they're most likely referring to the S&P 500. What makes the S&P 500 especially attractive to investors is its simplicity and accessibility. Many people choose to invest in the index through index funds or ETFs, which allow for broad exposure. Over the decades, this approach has yielded strong returns. From its inception in 1957 to the end of 2024, the index has delivered an average annual return of just over 10%. However, once inflation is taken into account, the real return drops to about 6.37% per year. Despite its benefits, one of the most significant but less frequently discussed issues with the S&P 500 is the weight. Rather than giving each of the 500 companies an equal share, the index is weighted by market cap. This means that companies with higher market values have a disproportionately larger influence on the index's overall performance. Consequently, a relatively small group of very large companies can drive the index, skewing its behavior and potentially introducing more risk. As of the latest data, this skew is especially apparent in the tech sector. Tech stocks now make up over 30% of the entire index, which is nearly double the allocation of the next largest sector. A large chunk of this tech concentration comes from just a few major companies. Apple, for instance, is the largest holding in the S&P 500, accounting for around 7% of the index. Microsoft follows closely at about 6%, and Nvidia also makes up another 6%. Other tech giants like Amazon, Meta, Alphabet, and Tesla also hold significant portions. When you add up the weight of these 7 companies, they collectively represent about 30% of the entire index. This concentration means that the overall performance of the S&P 500 is heavily influenced by just a handful of firms, particularly in the tech sector. If these companies perform well, the index does well. However, if they face challenges or experience volatility, the entire index can suffer, even if other sectors or smaller companies perform good. This level of concentration creates a hidden risk. While technology has been a major driver of growth and innovation in recent decades, it's more susceptible to certain market forces. For example, tech stocks often react strongly to changes in interest rates over investor sentiment. They can experience larger swings compared to more stable sectors like utilities or consumer staples. Since so much of the S&P 500 is now tied to tech, it's become more sensitive to these fluctuations. The evolution of the index composition also reflects broader shifts in the economy. When the S&P 500 was launched in 1957, it was dominated by industries like manufacturing, energy, and consumer goods. In the 70s, industrial companies made up a third of the index, highlighting the importance of sectors like transport and manufacturing during that era. However, the U.S. economy transitioned from being primarily industrial to service-oriented, like finance, healthcare, and especially tech. By the 90s, the tech boom was in full swing, with companies like Microsoft and Intel becoming key drivers. Since then, the tech has only grown in influence, and today it stands as the dominant sector in the index. With the growing dominance of tech, the overall dividend yield of the S&P 500 has also declined over time. Decades ago, when sectors like utility, energy, and consumer staples, which are known for steady and relatively high dividend payouts, had a larger presence in the index, dividend yields were higher. However, tech-heavy index features companies that tend to favor reinvesting profits into growth or share buybacks rather than distributing earnings to shareholders through dividends. As a result, the current dividend yield of the S&P 500 is near a record low of less than 1.5%. For investors who are looking for income from their investments, this trend can be a concern and also reflects the broader change in investment philosophy that's accompanied the rise of growth-oriented sectors. Many tech companies are focused on expanding rapidly, and while they may be extremely profitable, they often choose to reinvest rather than return cash to shareholders. This reinvestment strategy can pay off in the form of higher stock prices over the long term, but it also means less immediate income for investors who rely on dividends. One way to mitigate some of these risks associated with the traditional S&P 500 is to consider alternative investment strategies that still focus on the same group of companies but use different weighting methods. One such alternative is an equal weight S&P 500 ETF. Instead of giving more weight to the largest companies, this type of fund gives each company in the index an equal share. This means every business, whether it's a massive tech firm or smaller utility company, has the same impact. An equal weight ETF provides a more balanced exposure to the index. Because it does not rely so heavily on the top 7, it's tending to be more diversified. This can also lead to different performance outcomes compared to a market cap weighted ETF, particularly when smaller or mid-sized companies are outperforming the larger ones. It also reduces the concentration risk that comes with having such a large position of your investment tied to just a few tech giants. Beyond equal weight funds, there are also other specialized S&P 500 related investment vehicles that cater to different strategies or investor goals. Growth funds, for example, focuses on companies within the index that are expected to expand more rapidly than the market average. These funds prioritize capital appreciation and often have a high concentration of tech stocks, given the sector's strong growth history. However, they come with increased volatility. Value funds can take a position approach, concentrating on companies that are seen as undervalued based on fundamentals. These firms are often more stable and provide higher yield dividend. Value investing tends to appeal more to conservative investors who look for consistent, albeit slower returns over time. This approach echoes the strategy followed by famed investor Warren Buffett, who has long championed value investing principles. Income funds are another option that prioritizes generating regular cash flow through dividend payouts. These funds typically invest in sectors known for their reliability and steady earnings, such as utilities, healthcare, and consumer staples. While they may not offer the same level of capital appreciation as growth funds, they are favored by retirees or investors who need income for their investments. For those looking to focus on specific parts of the economy, sector-based funds offer targeted exposure to individual industries within the S&P 500. For example, one might choose a technology sector ETF if they believe tech will continue to outperform, or a financial sector if they expect interest rates to rise. While these funds can provide strong returns if they perform well, they also carry high risk. Warren Buffett has famously advised that the average investor is better off simply investing in a low-cost S&P 500 index fund and holding it for the long term. He also emphasized that even professional investors often fail to consistently outperform the market, and that the simplicity, diversification, and low fees of index funds make them an excellent option for most people. In fact, Buffett has stated that he plans to leave the bulk of his estate to be invested in a basic S&P 500 index for his wife, reflecting the deep confidence in this strategy. Still, as straightforward and effective as investing in the S&P 500 can be, it's essential to understand what the index actually consists of and how that composition influences its behavior. Over the years, the S&P 500 has changed dramatically. What was once an index dominated by industrial firms and dividend-paying companies is now led by fast-growing capital-intensive tech giants. For modern investors, staying informed about these shifts is crucial. Knowing which sectors and companies dominate the index can help explain why it performs the way that it does, and provides insight into how it might behave in various economic functions. While the S&P 500 remains one of the most trusted and effective tools for long-term investing, it's not something to invest in blindly. Recognizing its strengths and understanding its limitations and considering alternative strategies can all contribute to a more balanced and well-rounded portfolio.